Welcome, everyone. We will start things right at the top of the hour, so we'll give everyone another minute or so. Looks like we're right at 12 Central, so I'll just kick things off with saying good afternoon and welcome to our final session in our 2024 Yellowbook training series. Today we're going to be talking about emerging issues and trends. Before we head into the presentation, I just want to introduce myself. I'm Rachel Windett with Sikich University, and I will be on to support you all today. We also have Rachel Hawley in the background with our marketing team. She'll be assisting with questions, comments coming in. For CPE today, we will have 3 polls. They'll come up during the session. Make sure you complete all 3 of those polls for CPE. If you're joining us via a browser or tablet device of sorts, make sure you're on full screen because those polls can appear to be hidden if your tab is minimized. This recording will be made available on demand in a few days following this event. You'll receive an email with that information. So for this session, we're joined by Anthony Cervini, our state and local government audit leader. He's a principal here at Sikich, and along with leading SLG at Sikich, he has participated in hundreds of audits of municipalities and other governmental entities since beginning his career with us in 2005. He also has been responsible for serving as a lead instructor for governmental accounting, auditing, financial reporting, cash management, and internal control courses internally and throughout the Midwest. I also want to throw a big thank you out there for him for coordinating this learning series and for all of you for joining us throughout the year. If you do want to go back and view those sessions, they are available through On Demand. So without further ado, thank you again, everyone, for joining us. I'll hand it over to Anthony.
Wonderful. Thank you, Rachel. And hi, everyone. Welcome to, as Rachel noted, our 11th and final session of our 2024 Yellowbook series here, talking about emerging issues and trends, what GASB has been up to, what's on their radar, and what to expect and how that could impact you. Hopefully everyone is winding down their 2024, getting ready to enjoy the holidays, however you celebrate, hopefully going somewhere. If you're not in a warm locale, getting somewhere warm, as I know here in the Chicagoland area, I think snow squalls are in the forecast for a little bit later this afternoon. So always the joys of winter that we see here as well. So as Rachel noted, our topic for today is emerging issues and trends. As we get started here, we'll work our way through the deck. Information here, you see just our standard disclaimer here in terms of what we're presenting. These are opinions and information that we've gathered from the Governmental Accounting Standards Board as part of this. So certainly if you have questions or any of these items, again, we're not making any warranties or anything as part of this process here, but overall in terms of what's presented as part of today's session. Again, my name is Anthony Cervini. Let's go ahead and get right into it. We have quite a bit of material to cover in today's session, and we're going to start off with GASB Statement 100, Accounting Changes and Error Corrections. So our focus today will really look at some of the most recently issued pronouncements by GASB, as well as others that are in the works, various stages of the GASB standard setting process on that. So you're able to have that information at your disposal and to understand hopefully the impact of how this may affect your organization. Statement 100 covers accounting changes and error corrections and is effective for fiscal years beginning after June 15th of 2023. So you'll see the effective fiscal year end dates there. So our June 30th, 2024 fiscal year ends, this is already applicable for you, as well as December 31st and December 31st, 2024. Those of you that might be in April 30th, 2025. but basically any fiscal year end after June 30th, 2024 the standard is effective. What did GASB do with Statement 100? Well, GASB 100 really looked at taking the guidance that had been accumulated for many years in terms of how certain types of accounting changes were reported and error corrections were reported there, and really clarify those and give us some concrete guidance and incorporate all of those into one particular standard so we knew how to address these types of changes. It distinguished error corrections from those accounting changes. It talked about what we need to show from a recognition and disclosure requirement standpoint there, and then finally provided guidance on treatment for required supplementary information and other supplementary information as well, including in your statistical section. So what's changed? Some of you may have seen terminology that we've used in the past for prior period adjustments, whether that be an error that was noted in the financial statements, or if you had what we call a change in accounting principle or other types of items that flowed through your financial statements there. But really that terminology goes away. We have changes in accounting principle as from a retroactive standpoint there, and error corrections there. We can also have changes to or within the financial reporting entity, so adjustments within our financial reporting entity. And it's important to note as part of this standard that we now have to disclose the aggregate amount of those adjustments and restatements for each reporting unit on the face of the financial statements. So it can't just be a note disclosure, it has to be shown on the face of the financial statement. So you will see, we'll look at an example here in a little bit as to what the impact is on that and how that's presented. But again, these are the major changes that we saw come about with GASB Statement 100. So the first type of change that we're talking about is a change in accounting principle. So a change in accounting principle is when we're moving from one generally accepted accounting principle to another. And we have to have a caveat here that that newly adopted principle has to be preferable based on qualitative characteristics. So not just because the new principle makes you look better or makes the numbers present a different way, but it has to be qualitatively preferable based on the standards that we're looking at here. Generally, when we have implementations of new pronouncements, these are going to be treated as accounting principle changes. So for example, as you looked at implementing in recent years, GASB Statement 87 on leases, GASB Statement 94 on public-private or public-public partnerships, GASB 96 on subscription-based information technology arrangements, any of those, if those were applicable to your organization, likely had some sort of a change in accounting principle effect and would be treated as a change in accounting principle in that manner. How do we report changes in accounting principle? Well, this is one of the situations where GASB tells us that we have retroactive reporting for this change in accounting principle. So in single period presentations, you're going to restate that beginning position for the cumulative effect. If your organization presents comparative financial statements, you'll restate those financials for all periods presented, and then restating the beginning position of the first period presented for the cumulative effect of the change in all periods, if that's practicable. Now, one additional item to note here, that if practicable qualifier that GASB has put in, this standard as well as several other recent standards, view that as a high bar. Just because it's maybe a pain to go back and get that information there does not mean it's not practicable to do so. That would be more so understanding that practicability if the information for whatever reason is not available, you're not able to run the reports you needed for that there. If you do make that determination that it is not practicable, that would need to be disclosed in your report as well. What disclosures do we have as part of this? We need to talk about the nature of the change. If we do have a new pronouncement that we're implementing, identifying that new pronouncement there. What line items were impacted as part of this? Why the new principle is preferred. Now we do get an exception there. If it's a new pronouncement that we're implementing here, we don't have to include that there. If we're not restating all years, as I noted, we have to explain the why behind that, and then presenting that summary table disclosure there as well. So that gives us changes in accounting principles. The next category of our changes here is a change in accounting estimate. So changes in accounting estimates, first of all, we have to understand what is an estimate. What are we looking at as part of that estimate definition? These are amounts that are subject to measurement uncertainty that are recognized or disclosed in the basic financial statements. So one of the most common estimates that we see from a financial statement reporting standpoint relates to depreciation. Other estimates that you often see related to allowances for doubtful accounts or uncollectible receivables there. Other amounts that you may have, subject to estimates could be related to any pension liabilities or other post-employment benefit liabilities as well there. So you do have a variety of things that can kind of fall within that category. If we have changes to those inputs, those can come from, again, several different sources, whether those are changes related to circumstance, if we have additional experience that we've gathered, additional information that's come to light in terms of that might drive that change in accounting estimate. When we have changes to our accounting estimates, those are going to be treated prospectively. So we have no adjustments to the opening net position or opening fund balance in those circumstances. Those are reported in the period of change. Those are period expenses, period revenues. That impact goes in to, again, that current financial statement. No retroactive, no prior, nothing affecting previously issued financials or prior issued numbers as part of that. From a changes in accounting estimate from a disclosure, again, the nature of that change, along again with the reason for the change and why the new estimate is preferred as part of that. So if you're looking at capital assets as an example, that capital asset change, if you're moving to a updated useful life for several of your classes of capital assets there, that new estimate may be preferred because you have additional information and you have a better ability and better estimate for what the useful lives are on those capital assets. So again, so far we've got we have changes in accounting principle. Changes in accounting principle are retroactive. Changes in accounting estimates are done prospectively. The last category here from an accounting changes standpoint then is changes to or within our reporting entity. Now, the biggest one here that we'll talk about in more detail in just a moment here is when we have changes in fund presentation as major and non-major. And this will likely be the one for those of you that do have traditional municipality reporting here, where you have funds that may be major in one year and then not meet the criteria in a subsequent year, or vice versa on that. The impact to that and how that's going to be presented is definitely changing under GASB Statement 100. If you have funds that are added or removed from a continuing operations standpoint, that could fall under a changes to or within the reporting entity. If you have the addition or removal of component units, or the reclassification of component units, for example, from a discretely presented component unit to a blended component unit, or vice versa there. Changes to or within the reporting entity are recognized in the current period, and so we do adjust that current period beginning position here. And it also introduces for us this concept of a ghost column, which we'll talk about in just a moment. But with that, that brings us to our first polling question of the day. So again, please make sure that if you are looking for CPE credit today, that you do answer all of the polling questions that we go through as part of the presentation. So our first polling question of the day, we'll go ahead and launch that here for you.
All right, so have you seen snow yet this winter? So we have a lot, a little, none yet, or not expecting any. I know out here in the Illinois area, we've had a little bit of flurries this morning, northern Illinois.
A little bit. Rachel, I would say that since 2 years ago, when my family and I moved into a new house down the road and bought a new snowblower, the amount of snow that actually requires the use of a snowblower has been really disappointing. So if anybody is looking for me to buy another new snowblower and keep winter, at bay, let me know, and I'll do the best that I can for that. So.
Yes. All right. So I ended that poll.
All righty. You'll see a theme here as we go through our polls for today too. But let's talk about ghost columns. Ghost columns. This was, I was trying to maybe go as a ghost, ghost column for Halloween, but did not kind of work with the family theme here this year. So let's talk about what a ghost column is, what that impact is here, and how we're going to report that. So here on this screen, you see a governmental fund, statement of revenues, expenditures, and changes in fund balance. Here you have your major fund category. So your general fund is a major fund, and your tax increment financing number 3 fund in this case is also a major fund. Still have our non-major governmental funds presented in the third column, but our total governmental funds in the far right column here. But what's different here, what you'll see here, and we'll look at it on the next slide here, is we've got a new line presented here. We got a couple additional lines down here. So what we're showing is that the fund balances at the beginning of the year, as those were previously stated, we see those amounts reported there. So if we look here for general fund, for example, and the non-major governmental funds, we see those amounts as well. The reason we have these ghost columns, and the whole reason behind why GASB did this, is because if a financial statement user was looking at the prior year financials, historically, if this TIF fund had been reported as a non-major fund in prior years, which in this example it was, then you would just see fund balance January 1, and everything would be on this line here. You wouldn't have this line here. So somebody looking at last year's report would say, well, non-major governmental funds has a different opening balance than what was the ending balance in last year's report. What gives? What's the difference? Why is that happening here? So this is where we get this idea of these columns or this presentation here. And so as noted, we have a change within the financial reporting entity here. And what we're showing is that this tax increment financing number 3 fund, as a major fund, it had no beginning balance, but we did change the financial reporting entity to move it from a non-major to a major fund presentation. So we're increasing the fund balance here to show that, and then we're removing the fund balance from the non-major funds where it was presented previously there. We then end up at the same number there. It's a wash between those amounts in terms of the net effect on our fund balance there. And then ultimately, as adjusted or restated, we're showing that opening balance there as well. That means now someone can look at the prior year financials, tie these amounts out to what they saw in last year's report, see the change this year, see that the total hasn't changed again, but ultimately the classification, the change within that financial reporting entity is presented in that manner. Now, what happens if we go the other direction? What if we have a situation where we have a fund, the TIF fund was major, and perhaps it's winding down, or perhaps it's no longer major? Well, this is really where we have this ghost column. This is our ghost column here, right? So we have this header here. This is for illustrative purposes, but basically noting this fund that was formerly major, and then our change within the financial reporting entity. So again, that opening balance that we've presented stays the same as what it would have been presented in the prior year report. But then we're removing it from the financial reporting entity, through this separate line down here, as we've got noted here. So we're seeing those amounts that are coming out there. Again, the overall fund balance is not changing there. It's just making it more clear from a financial statement reader standpoint there, as to say, okay, well, here's where we ended, here's where we started, and here's what those changes relate to there as well. You can argue whether or not that will be understood by a financial statement user. That's certainly your prerogative on that, but that's what the intent is here in terms of sharing this information with GASB and what they were trying to do as part of this. If you're looking for an additional example on this or additional information or explanation on this, I would encourage you to check out the GFOA short, what they call their timely accounting discussions video, or the GFOA just a tad video on this, where they also do about a 10-minute debrief on these columns as well, and use some examples to share that kind of what the intent is here as well. So again, keep that in mind as you're looking through things there. Talk through, as if you have funds that are often major funds in one year, based on capital expenses or capital expenditures, things of that nature, and maybe that changes from year to year or fluctuates from year to year, determining whether or not, more often than not, is it something that is going to be a major fund? What's the easiest presentation standpoint there? How do you want to handle that? Have those discussions as appropriate. For our changes to or within the reporting entity, then again, our disclosures that come with this, we have to disclose the nature of the change and the reason for the change. We do not have to disclose that major, non-major change if it's only related to that quantitative, criteria for that as well. So again, keeping that in mind as you look at Statement 100, as you look at those changes to or within the reporting entity. So that gives us our 3 types of accounting changes. Our final thing that's covered in Statement 100 are error corrections here. An accounting error is when we have any variety of things, mathematical mistakes, misapplication of principles, oversight, or misused facts as part of that, and tells us that we need to have a retroactive recognition of those amounts there. Very similar in terms of the treatment that we saw for changes in accounting principle, based on whether you present on a single period or comparative period there. Disclosure requirements come with this as well. So the same, very similar disclosure requirements that we're looking at here, the nature of that error, the periods affected by that error, what line items were impacted, the effect on the prior period, the effect of the correction on the change in net position, and then finally a summary table disclosure there as well. So what's it all look like in a disclosure standpoint when we're all said and done? Well, that brings us here in terms of being able to look at a sample table. Now, again, you have to have this information not only in, you have a note disclosure for this, but also within the face to the financial statement. So again, there is kind of duplicative requirements in terms of how this information is presented here. But in our example, this comes directly from the standard here. So during the fiscal year, changes to or within the financial reporting entity and an error correction resulted in adjustments to and beginning net position restatements and fund net position. So they show the amounts here. So here's the previously reported net position or fund balance. In this case, they had a change of a component unit from a blended to a discrete presentation. They added a discretely presented component unit, and they had an error correction here. So again, the respective opinion units, so Enterprise Fund D, both the governmental and business type activities, as well as the two foundation component units that were impacted there. We look at required supplementary information and supplementary information when we have changes in accounting principle or changes to or within the reporting entity. We want to report that information consistently there as part of that for the years that are presented in the basic financial statements. For years that are presented prior to those presented, we're not going to restate those, so we're just going to explain those changes there as well. So that is GASB 100 summarized in terms of the impact there. So again, our three types of accounting changes, as well as our error corrections on that, kind of a, again, a aggregation of guidance that had been out there in some way, shape, or form from GASB over some time, and putting it all into this particular standard. Up next is GASB Statement 101 on compensated absences. Now, we've done separate sessions on this, so this will be a bit of a higher level review of GASB 101. If you do have additional questions or looking for additional training on GASB Statement 101, I encourage you to go out to our on-demand links and on-demand series here, and you can watch that separate session as well. But GASB Statement 101 on compensated absences is effective for fiscal years beginning after December 15th, 2023. So this is December 31st, 2024. It's applicable for us right now, as we'll see here, right? December 31st, 24, April 30th, 25, June 30th, 25. Now, why do we have a new standard for compensated absences? What's GASB trying to do here? What's the intent of this? The general question we often ask ourselves, just why? What are we doing here? GASB ultimately decided they needed updated to the compensated absence. They needed an update to the compensated absence standard for us to be able to have additional and better information for financial statement users, and looking at that measurement and recognition guidance that we have for compensated absences. Trying to come up with a unified model and making some amendments and modifications to the previously required disclosures there. But ultimately, it all kind of started with a definition, right? In terms of, what are we calling a compensated absence? How are we reporting that? What is our effect there? So compensated absences can be defined as cash payments when the leave is used for time off. If we have other cash payments, including payments that are, for unused leave upon termination of employment, or if we have non-cash settlements such as conversion to post-employment benefits. Some examples that we might have seen for compensated absences: vacation and sick leave, paid time off or PTO, holidays, parental leave, certain types of sabbatical leave, all things that could fall under that definition of compensated absences. Accrued liability reporting required separate categorizations there. And as we look at that, then if we have that leave that's accumulated and hasn't been used by the employees or otherwise paid or settled, we can see that in the different types of forms that we've seen here, whether that be our compensated absences liability. If we have defined benefit pension or OPEB liabilities, those could fall into that category as well. We also have leave used by employees that's not yet paid by the employer. So these are salary and payroll taxes payable, as well as defined contribution, pension, or OPEB contributions that we may have as well. Now, one thing to note here from a modified accrual standpoint here on our governmental fund financial statement, no measurement impact that we're looking at here as part of GASB Statement 101. So when do we have recognition? When do we have to recognize a compensated absence, right? That's the kind of the big question that we need to answer as part of the standard here. Leave that has not been used, we have to have 3 things and 3 criteria met for this to qualify as a compensated absence. First, it has to be attributable to services already rendered. 2, it has to accumulate. So that means it can accumulate and carry forward from one reporting period to the next. And then finally, it's more likely than not, so 50.1% or anything above 50%, to be used for time off or otherwise paid or settled. Leave, if we have leave that is used but not paid, we have a liability for the amount of that cash payment or non-cash settlement. We would also include any salary-related payments as part of that calculation as well. So when we look at the measurement of that compensated absence liability, there's 2 components that we need to consider on that. First being the pay rate. We're going to use the employee's pay rate as of the financial reporting date. Now, unless there is a compelling reason or a strong reason that it's much more likely than not to be paid at a different rate, then you would use that. You can use an alternative rate there. But again, in most cases, remember, you're looking at a balance sheet calculation. You're looking at a point in time calculation there. So being able to understand that as of that balance sheet date, and the question I always pose to folks on this as well is, if everybody were to leave today, what would you have to pay and what rate would you pay them at there, regardless of whether or not maybe rates go into effect on the first day of the new fiscal year. If you would pay them out at the old rates that are still applicable, then that's the rate you should use there. So more often than not, you're going to use that rate in effect at the financial reporting date. I mentioned earlier that you can have also salary related payments as part of this as well. Those can be directly and incrementally related. So if we have defined contribution, pension, or OPEB recognized, we're going to recognize that as that related leave is earned. We don't have this included as any sort of a pension or OPEB liability. If we have a defined benefit pension or defined benefit OPEB, that's actually excluded from the financial reporting. So again, this information for at those salary related payments that you have. So here's an example. An employee's annual pay is $100,000 as of June 30th. It increased to $110,000 on July 1st. We're going to calculate that liability based on that $100,000 salary in effect at June 30, assuming we're at June 30th fiscal year end. That rate increase that they received as part of that will just factor into the calculation of the liability in the subsequent year. Also enjoy that they're getting a nice 10% raise as part of that as well. So good for them. So when do we have, with any standard, we always have exceptions that we need to consider. So exceptions to our general recognition approach that we have as part of this standard here. If we have leave that's dependent on the occurrence of a sporadic event that may only impact a relatively small proportion of employees, and we're looking at that from a particular reporting period there, we'll recognize that liability when the leave commences for the entire period. This could be parental leave, military leave, jury duty, things of that nature. We don't factor in sick leave or sabbatical leave here. So for example, if we're looking at the liability and structuring it under Statement 101's guidance here, if we have an employee who begins a 90-day parental leave 30 days before fiscal year end, technically you have 60 days of leave liability that gets reported for that individual. Now again, think about these things and talk to from an audit consideration, from a materiality consideration, those things all factor into that as well. Oftentimes you're not going to have a large enough number of people that are going to be out on these types of leaves that would have a significant material impact from an audit standpoint. At least that's the expectation that we have for that. Other exceptions here: leave that's more likely than not to be settled through conversion to a defined benefit other post-employment benefit or defined benefit OPEB plan here. It's not recognized as a compensated absence liability. These are amounts that should be calculated and factored in by the actuary in their determination and their evaluations of that pension or other post-employment benefit liability for you there as well. If you do have unlimited leave or date-specific holiday leave there, you'll recognize that liability when the leave is taken. So employees who are entitled to a paid day off on January 1st, if they are in active service at the end of the day on December 31st. In this case, we have no liability to report at December 31st on the year-end financial statements there as well. If you're in a situation where you have the ability to accumulate unlimited leave, but maybe you're only eligible for a settlement of a portion of that, then you have a max days or max dollar amount there. Old guidance told us to accrue a liability up to that maximum settlement value. New guidance here, accruing a liability for the accumulated leave more likely than not to be used. Other considerations here, defined contribution, pension, or OPEB expense calculation here. You see what that calculation looks like for that pension or OPEB expense. So contributions or credits to the employee's account as defined by those benefit terms, plus or minus any increases or decreases in the liability pertaining to those salary related payments for the defined contribution, pension, or OPEB. Now, we actually get some good news here. No new note disclosures. One of the rare cases where we have a new standard that has no new note disclosures associated with it. Exceptions that we have are changes to the existing disclosures there. For those of you that participate, for example, in the GFOA Certificate of Achievement program, you may have seen a comment at some point over the past 20 some years where if you just presented a net, a net increase or decrease in your compensated absence, GFOA may have said, oh, you need to present those numbers gross. Well, you no longer have to present them gross. You just have to have a note disclosure indicating that it is a net change there. You are also no longer required to report the governmental funds used to liquidate that. So again, very high level in terms of kind of what we're covering on Statement 101, but just want to have that information available for you. Again, if you have additional questions there, strongly encourage you to go back and look at our previous recording that talks about factoring in GASB 101, what amounts are calculated there, looking at the impact on amounts that maybe are not paid out as part of that, but you have to factor in what portion of that is expected to be used through other means. Sick time, probably the most common one that we're having discussions with our December 31st year-end clients on how that's treated and how they're going to calculate that. But again, if you have questions on that, watch the previously issued session, or feel free to reach out to me as well, and I'll direct you to that or do my best to answer any questions. But with that, that brings us to our second polling question of the day. So again, you need these for CPE, so polling question 2.
Yes, so you should see that popped up. From the below list, which is your favorite film? Christmas Vacation, Elf, The Grinch, The Holiday, The Santa Claus.
Your favorite, Rachel?
I love Christmas Vacation.
It's a classic. It's a classic.
Yes.
I'm
How
a
about you?
big fan of Elf. Big fan of Elf. It's often quoted in the Cervini house during the holidays here as well. And anytime that somebody refers to Santa smelling as beef and cheese, it's always a well received movie line there. So
Love it.
all right.
Apparently, Christmas Vacation and Elf are the top two.
All right. Well, we got good taste then, so we are aligned. Moving right along to GASB 102. GASB 102 covers certain risk disclosures. So on Statement 102, effective for fiscal years beginning after June 15th, 2024. So this is June 30, 25, and fiscal year ends thereafter. As you can see, GASB looking to provide timely and relevant information regarding what are now defined in Statement 102 as concentrations or constraints as part of that. So earlier this year, I had the chance to attend the National GFOA session and listen to the Director of Technical Services for GASB talk about Statement 102. And he really, highlighted that, that he doesn't expect that this is necessarily going to be applicable to a lot of organizations, but it is still out there. You do still want to be aware of it. So when do we have disclosure required under 102? Well, we have vulnerability. That's what drives any necessary disclosure requirements here. And we have to have concentrations or constraints. We have to think about the occurrence or likelihood of those as part of that requirement, disclosure requirement. Which components are impacted here? Both the primary government is going to be impacted. And then if we have other reporting units with revenue debt as part of this as well. So let's, for us to understand kind of the impact here, we need to really go back and look at those definitions. First, for a concentration. So a concentration is defined in the standard as a lack of diversity in an aspect of a significant revenue source or expense. This means within our organization, our community, if we have, principal employers, principal industries, resource providers, composition of a principal inflow of resources, concentrations on our workforce and our suppliers there. These are all things that can fall under the GASB 102 definition of a concentration. Alternatively, if we look at a constraint is imposed by an external party or our government's highest level of decision-making authority. This could limit our ability to acquire resources or control spending. So if we have limitations on raising revenue, limitations on spending, limitations on the incurrence of debt or mandated spending, these are all things that could fall under that definition, or that do fall under the definition of a constraint. Now, just because you may have some of these things doesn't necessarily mean you have a disclosure. So when do we have to have a disclosure related to these concentrations or constraints? Well, first, we need to have that concentration or constraint be known prior, and it has to exist prior to the issuance of the financial statements. It also has to make the government or the reporting unit vulnerable to risk of substantial impact. Finally, if we have events or events that are associated with that concentration or constraint, then we have to look at those events and say, okay, one, have they occurred? Have they begun to occur? Or are they more likely than not to occur within 12 months of the financial statement issuance date? Okay, so we have all these criteria here. We have a concentration or constraint that's known prior to financial statement issuance. Let's say it does make us vulnerable to substantial impact. And let's say these events have begun to occur, right? Well, do we have disclosure requirements there? Well, maybe, but possibly not. Why not? Why would we be able to potentially avoid that? Well, if we've taken mitigating actions, or if you've taken mitigating actions as part of that prior to the issuance of those financial statements, and it causes any of those disclosure criteria to not be met, then none of those disclosures are required. So you get a pretty big, caveat or pretty big exit opportunity here from having this disclosure requirement applied to you. And this is only important to know, this is a disclosure standard only as part of this. So if we go back and look at the concentration example, right? Let's say, hey, we have a principal employer. We find out during the course of a year that we have a principal employer. Maybe we're a smaller community, and this particular employer employs a significant portion of our workforce, and they tell us that we're shutting down, we're closing up shop, and that a significant number of people in the community may be impacted by that. It really is going to increase tax revenues. So in this case, maybe it's known to exist prior to the financial statement issuance. Are we vulnerable to substantial impact? We could be, and it's either has begun to occur, or maybe it's more likely than not to occur as part of that. But in that example, if we have talked to another company who maybe is going to come in and has signed an agreement to come into that place, or we're taking those mitigating actions, and basically we know that, okay, the company, perhaps they are closing because they were acquired, but the acquiring company is going to come in and use the the building or the facility in the same manner for that, then we might have the opportunity here to not have anything that needs to be disclosed as part of this as well. So again, thinking about those mitigating actions, whether or not it does cause any of the criteria to no longer be applicable. If it's no longer applicable, then again, that disclosure is not required. So in our example here, if we have, let's say we do have disclosures that need to be, included in our financial reports here. For each applicable concentration or constraint, we need to note the nature of the circumstances disclosed, the vulnerability to risk of substantial impact. We need to have a description of the concentration or the constraint, identifying each associated event if they've occurred or begun to occur, as well as the status of any mitigation efforts that may be in place. Here's an example for us. So this is the concentration of workers that are covered by a collective bargaining agreement. In this example, the district depends on its workforce to deliver transportation services. All of those workers are covered by a CBA with the state association that expires on June 30th. And a labor disruption that decreases bus, train, and subway services could disrupt the normal functioning of the district's operations here. Now, so this is again, comes directly from the standard here. So if negotiations were ongoing or other things that were mitigating those efforts there, again, that could either limit or potentially even eliminate this disclosure requirement as, in its entirety for that. So again, relatively straightforward standard GASB Statement 102 there. So keep that in mind as you are looking at things from a disclosure and a requirement standpoint. GASB 103. Now, GASB 103 is one that we have been talking about at Sikich for years, honestly, because this was for quite some time the largest scale project that GASB had on its technical agenda, and basically was looking at at certain times a complete overhaul of the GASB Statement 34 reporting model. Now, if that gives you anxiety, gives you pause, and say why we just started to be able to get folks to maybe understand the GASB 34 model and all those pieces there, you're not alone if that's how you feel. And I've got good news for you today is that GASB listened to those concerns, and GASB understood and heard all of that information. And at that same session I was at earlier this year, they talked about, well, you know what, we're going to go from one exception-based reporting model to another exception-based reporting model, and ultimately they drastically reduced the scope of Statement 103, which we'll cover here. The impact will be markedly less significant than what had been proposed over the years in terms of what the standard could have been. So again, this was an example of GASB's process working in terms of looking at the due diligence that they did. Obviously, with the standard and the potential impact here, there was a lot of GASB went out and did town halls and a listening tour. A lot of comments that were provided on the basis for exposure drafts and preliminary views and things of that nature there. So what did we end up with in Statement 103? Where did we land on things here? Effective for fiscal years beginning after June 15th, 2025, so June 30, 2026 and thereafter. Early implementation is encouraged for this here, but overall looking to improve key components of the financial reporting model, providing better information to financial statement users at the end of the day is the goal here. So what are we changing in terms of this? Well, management's discussion and analysis, which we'll cover in just a few moments here as to what's changing, are unusual and infrequent items. So we have a terminology change from extraordinary and special items. We'll see some changes to proprietary fund financial statements, major component unit presentation, budgetary comparison information, and then finally the statistical section, financial trends information there as well. But the last point, I think, is the best point here. There is no changes to the governmental fund measurement focus or basis of accounting, which was going to certainly be the largest impact that we had with Statement 103, again, as it was previously being thrown around and talked about there. So MD&A, the biggest piece in MD&A, and I can really sum this up, right, is that MD&A is often viewed by financial statement users as too generic. It tells you, okay, here's how much the amount's changed, but it's missing the why. It's missing the actual analysis piece in terms of that. So GASB said, let's try to simplify that. Let's look at how we can make MD&A better as part of that. So on our current sections for the MD&A, here's what we have. All the components that are required here. You're probably all very familiar with information that's required under current MD&A. GASB said, let's scale that back and let's pare that down a little bit and simplify what we're looking for here. So the overview stays, the financial summary stays, that detailed analysis, the part that's really been missing both from GASB's perspective as well as GFOA's perspective in terms of their process there, a discussion of that significant capital asset and long-term financing activity, and then finally any currently known facts, decisions, or conditions that may exist there. Our new terminology here are unusual or infrequent items. Again, it's a replacement terminology here. Definition does not change, so the transactions or events still need to be unusual in nature and infrequent in occurrence here. So unusual in nature means an event or transaction is abnormal or significantly different from the ordinary and typical activities that we see. Infrequent or occurrence, an event or transaction is not reasonably expected to recur in the foreseeable future. Simple things like regular things that could happen from a year-to-year standpoint would not meet this criteria here. So again, a high bar to meet this. Presentation requirements dictate that these are the last items presented before the net change, a change in net position or change in fund balance. Multiple items, you're going to present those gross and not net those amounts there. So in this example, if we had a disaster recovery grant intended to help governments recover from an unusual or infrequent natural disaster and a corresponding impairment loss from that damage caused by that same natural disaster, those are presented gross and not on a net basis there. Proprietary fund financial statements gives us a new category here. So if we look at this example, operating revenues, an existing category, operating expenses, existing, still coming to an operating income or loss. We then have this new category here of non-capital subsidies. Non-capital subsidies being, if we have amounts that are being transferred in for operational purposes to a proprietary fund financial statements or other non-capital reasons there. Gives us this new category then of operating income or loss and non-capital subsidies. Non-operating falls below that line there. Income or loss before any unusual or infrequent items, and then finally our increase or decrease in the net position for that fund. Those non-operating revenues and expenses would include, subsidies received and provided. So again, capital versus non-capital, the important differentiation here. If you have other amounts related to investment income, capital asset, sales, financing, things of that nature that it could potentially impact there. Operating revenues and expenses basically gets defined as everything else that we have within the the operating fund or the operations of the fund. Subsidies, resources that are received from another part of your fund. We do not receive goods or services for this, and they are directly or indirectly keeping the fund's current or future fees charges lower than they would be otherwise. If we're providing resources to another party or fund, again, that recipient is not providing us any goods or services or the fund any goods or services there. And these are recoverable through the fund's current or future pricing policies, and then all other transfers would fall under that subsidy categorization as well. Major component units, each major component unit should be presented separately in the government-wide financial statement. You can also have a single column if it becomes a readability issue there. Combining major component unit financial statement, combining major component unit statements would be presented after the fund financials. The a key change here, no longer allowed to present those condensed statements in the note disclosures. Some folks have taken advantage or utilized the ability under GASB Statement 34 to report budget versus actual statement for the general fund and major special revenue funds as part of the basic financial statements. That's no longer allowed under GASB 103. Also required, it does have to be as part of the required supplementary information or RSI. 2 variance columns are required, the variance between your original and final budget, as well as a variance between the final budget and the actual results. And then the notes to RSI, either on the face of the statements themselves or separate notes to RSI section necessary to explain significant variances. Finally, in the statistical section, financial trends information, if you only have business type operations or business type and fiduciary operations, presenting those revenues by major source, distinguishing between your operating income or loss, those non-capital subsidies, and your other non-operating revenues and expenses. With that, that brings us to our third and final polling question of the day here. So I'll turn it over to Rachel to launch that for us as we finish up looking at kind of what GASB has on their agenda.
All right, so we've launched that poll. It's that time of year. What is your favorite hot drink for the season? Flavored coffee, plain coffee, tea, hot cocoa, or cider? I don't really prefer any of these. It looks like the flavored coffee, plain coffee is always a winner, all year round, really.
I mean,
Ooh,
can't really go wrong with coffee, but
yeah, hot cocoa and cider looks like it's the one that won. Great,
I mean, it's
switching it
the
up a
reason for
little.
this, the seasonal drinks, right? It's we all have our something about peppermint hot chocolate always kind of just feels
Yeah.
like it tastes like Christmas. So, all right. GASB's agenda, kind of what's out there, what do we have, and what is coming down the pike here for you as well. So the good news is that there's some time before any of these are going to be effective in terms of full new standards being issued outside of the classification of non-financial assets, which we'll talk about in just a moment here. GASB also is going through and doing a looking at, and has issued will be issuing a PV document on going concern and severe financial stress, their 2025 implementation guidance, infrastructure assets, revenue and expense recognition, and subsequent events are all out there, all kind of on the technical agenda for what GASB is working through. Classification of non-financial assets was issued in Q4. They actually ended up issuing this as GASB 104. I'd say it may have been right on the right at the end of Q3 in September, possibly on this. But this is really looking at the existing classifications that we have for those non-financial assets, so particularly looking at leases, SPIDAs, those intangible assets, capital assets, and how those are reported there as well. So again, for those of you that have implemented those standards there, from what we've seen on this, most have implemented it in a way that this really won't have much of an impact in terms of your reporting, or you probably reported it correctly already on that. So don't expect there to be a ton of changes related to this. Going concern uncertainties and severe financial stress. In most cases, going concern is not a meaningful benchmark or consideration for governments here. So information on severe financial stress could be, and that information is lacking. So you see the standard here, not even expecting a final standard until Q2 of 2027. Revenue and expense recognition, probably the other big one that's out there in terms of kind of what GASB is working on. There's limited guidance on exchange transactions right now. Non-exchange transactions covered by GASB 33, improving and kind of revisiting and clarifying that. And GASB is really kind of, again, lacking guidance on expenses. So exposure draft, consideration in 25, final standard, tentatively slotted for Q2 of 2027 on that. As always, we'll continue to update you in terms of what's out there from a GASB standpoint, what is coming down the pike on that as well. With that concludes our 11th and final session for the 2024 Yellowbook Series. I want to thank everyone for their time, for joining us. If you joined us for just this one, or if you've been with us all year in terms of the Yellowbook sessions on that, we're grateful for the time you've invested with us on that. Hopefully you found these to be beneficial and helpful from a training standpoint and a CPE standpoint there. As always, if you have questions that you submitted throughout the course of today's presentation, we will, if appropriate, we'll work to get back to you and address any questions that you may have there. But with that, I will go ahead and turn things over to Rachel to go ahead and close this out. Thanks, everyone.
Thank you again, everyone, for joining us. Thank you so much, Anthony. We really appreciate you being here with us and speaking to us. And I hope everyone has a wonderful holiday season, and we will see you in 2025.
Rachel, thank you. Both Rachels for all the support behind the scenes and making this happen. But happy holidays, everyone, and be well. Thank you.
Thanks all.